Here's something most people misunderstand about Charlie Munger's wisdom. He didn't discover secret formulas for getting rich quickly. He spent decades identifying and articulating the obvious principles that most people either ignore or fail to practice consistently. His financial rules weren't revelations. They were reminders of what rational thinking looks like when applied to money and investing, stripped of emotion, hype, and self-deception. The real question is not whether you know these principles intellectually. The question is whether you actually live by them. Munger passed away in 2023 at age 99, leaving behind not just enormous wealth, but a framework for thinking about money that anyone can apply. What made his approach valuable was not complexity but clarity. He took timeless principles about human nature, mathematics, and rational decision-making, and he applied them relentlessly to investing and life. He didn't claim to be smarter than everyone else. He claimed to be more disciplined about avoiding stupidity, and he built systems that prevented him from making the mistakes that destroy most people's wealth. The rules we'll discuss today are not direct quotes positioned as a numbered list that Munger published. Rather, these are principles distilled from decades of his speeches, writings, interviews, and the approach he demonstrated through his partnership with Warren Buffett at Berkshire Hathaway. These are the ideas he returned to repeatedly, the frameworks he insisted were essential, the wisdom he believed separated successful investors from everyone else. Understanding these rules matters because they're not just about investing. They're about thinking clearly in a world designed to make you think poorly. They're about making decisions that serve your long-term interests in an environment that constantly tempts short-term gratification. They're about building wealth sustainably rather than gambling on luck or following the crowd into disaster. If you master these principles, you won't just become a better investor. You'll become a better thinker, and better thinking produces better outcomes across every domain of life. Let's examine the 15 financial rules that capture the essence of Munger's approach to money, investing, and rational decision-making. These aren't shortcuts or tricks. They're disciplines that require effort to implement, but that compound in value over a lifetime. The first rule is to invert. Always invert. Munger borrowed this from mathematician Carl Jacobi, and it became one of his most frequently cited principles. Instead of asking, "How do I succeed?" ask, "How do I fail?" Instead of, "What should I do?" ask, "What should I avoid?" This inversion reveals risks and mistakes that forward thinking misses, because it's often easier to identify what destroys wealth than what creates it. Applied to investing, inversion means asking what would cause you to lose all your money, then systematically avoiding those things. The answers are illuminating and practical. Taking on debt you cannot service destroys wealth, so avoid excessive leverage. Investing in things you don't understand destroys wealth, so stay within your circle of competence. Panic selling in downturns destroys wealth, so build systems that prevent emotional decisions. Following the crowd at market extremes destroys wealth, so think independently. This principle is powerful because most people focus exclusively on positive outcomes while ignoring the many ways they can fail. They imagine success without mapping the path to failure. Inversion forces you to confront what can go wrong, making you defensive in useful ways. The investor who inverts asks not just what could make this investment succeed, but what could cause permanent loss of capital. This question reveals risks that optimistic analysis obscures. The practical application is to make inversion habitual. Before any significant financial decision, explicitly ask, what would make this fail? What am I assuming that might be wrong? How could I lose money on this? If those answers are unacceptable or unclear, don't proceed. This simple practice prevents countless mistakes because most disasters are foreseeable if you bother to look for them. The second rule is to stay within your circle of competence and know its boundaries. Munger and Buffett emphasized relentlessly that you don't need to understand everything. You need to understand a few things deeply and avoid everything else. Your circle of competence is the domain where you have genuine knowledge and insight. Operating within it gives you edge. Operating outside it is speculation, regardless of how confident you feel. The challenge is that most people dramatically overestimate their circle of competence. They read a few articles about an industry and think they understand it. They hear a compelling story about a technology and believe they can evaluate it. This overconfidence is expensive because it leads to investing in situations where you have no real edge, competing against others who know far more. Munger's approach was to be brutally honest about the boundaries of his competence. He avoided technology stocks for decades because he didn't understand them well enough, even though they produced spectacular returns for others. He stayed focused on businesses he could analyze with confidence, simple business models, understandable competitive advantages, predictable cash flows. This discipline meant missing some opportunities, but it also meant avoiding catastrophic mistakes in areas where he lacked genuine insight. The practical application is threefold. First, explicitly define your circle of competence. What do you genuinely understand? Where do you have knowledge and experience that gives you insight? Be honest and specific. Second, respect the boundaries. When opportunities arise outside your circle, the default answer is no, regardless of how attractive they seem. Third, expand your circle slowly and deliberately through serious study, not through superficial reading. If you want to understand a new domain, invest years in learning it properly before risking significant capital. The third rule is that it's remarkable how much long-term advantage you get by trying consistently not to be stupid rather than trying to be very intelligent. This might be Munger's most important principle because it reframes success as avoiding failure rather than achieving brilliance. Most financial failure comes from unforced errors, from doing obviously stupid things, not from missing subtle opportunities. What does avoiding stupidity look like in practice? It means not taking on debts you cannot service, even when easy credit is available. It means not investing based on hot tips or trends you don't understand. It means not making permanent decisions based on temporary emotions. It means not confusing a bull market with genius. It means not following the crowd into obvious bubbles. These are not sophisticated insights. They're basic prudence, yet most people violate them repeatedly. Munger believed that success comes more from avoiding disasters than from making brilliant decisions. If you can prevent catastrophic mistakes, mediocre decisions produce acceptable results over time through the power of compounding. But brilliant decisions mixed with occasional catastrophic mistakes produce terrible long-term results because catastrophic mistakes destroy the compounding that would otherwise work in your favor. The practical application is maintaining a checklist of obvious stupidities to avoid. Don't invest money you'll need soon in volatile assets. Don't use leverage. Don't invest in businesses you don't understand. Don't sell in panic. Don't buy in euphoria. Don't mistake activity for progress. These simple rules, followed consistently, prevent most wealth destruction. They're not exciting, but excitement in investing is usually expensive. The fourth rule is that envy is a truly stupid sin because it's the only one you can't have any fun at. Munger often observed that most of the other sins at least provide some temporary pleasure, but envy just makes you miserable while encouraging destructive behavior. Yet envy is one of the most powerful forces in financial decision-making, and it destroys wealth systematically. Envy manifests as keeping up with peers, buying things to signal status, and making investment decisions based on what others are doing, rather than on your own analysis and goals. Someone buys a luxury car, so you feel pressure to buy one too. Someone claims spectacular investment gains, so you abandon your strategy to chase similar returns. Someone appears wealthier, so you increase spending to maintain perceived relative position. All of this is destructive. The luxury car consumes resources that could compound. Chasing others' investment gains leads to buying high and selling low. Spending to maintain relative position creates lifestyle inflation that prevents wealth accumulation. Envy makes you optimize for appearances rather than actual financial security, and appearances are expensive while security is achieved through boring consistency. Munger's antidote to envy was focusing on absolute progress rather than relative position. Are you building wealth? Are you becoming more financially secure? Are you making progress toward your actual goals? If yes, that should be sufficient regardless of what others achieve. Comparing yourself to others is a trap because you'll always find someone wealthier, and the comparison generates no useful information about whether you're making good decisions. The practical application is deliberately limiting exposure to envy triggers. Reduce social media consumption that creates constant comparison. Choose reference groups carefully. Focus on your own trajectory. Define success in absolute terms related to your goals rather than in relative terms related to others. When you notice envy arising, recognize it as a signal that you're optimizing for the wrong things and redirect to what actually matters. The fifth rule is that the best thing a human being can do is to help another human being know more. Munger viewed teaching and sharing knowledge as both moral obligation and practical wisdom. This principle applies to financial education and to life generally. When you share what you've learned, you reinforce your own understanding, you help others avoid mistakes, and you contribute to a culture of rational thinking. In investing, this means being willing to discuss your reasoning, your mistakes, and the principles that guide you. It means writing down your thinking, which forces clarity. It means engaging with others who are trying to learn, not to show off, but to genuinely help them understand. The financial services industry often obscures rather than educates, making investing seem more complex than necessary to justify fees. Countering this with clear education is valuable. The practical application is to teach what you learn. When you understand a financial principle, explain it to someone else. When you make a mistake, share what you learned from it. When you find useful frameworks or rules, document them and discuss them. This serves others and also serves you by deepening your understanding and forcing you to articulate ideas clearly enough to teach them. The sixth rule is to acquire worldly wisdom through a lattice work of mental models from multiple disciplines. Munger believed that narrow expertise is fragile and that sound decision-making requires drawing on insights from psychology, mathematics, biology, physics, history, and other fields. Most people think about investing in purely financial terms, but the best insights often come from other domains. For example, understanding compound interest requires mathematics. Understanding market behavior requires psychology. Understanding competitive dynamics requires biology and game theory. Understanding cycles requires history. The investor who thinks multidisciplinarily has tools that specialists lack. They can recognize patterns that others miss because they are viewing situations through multiple lenses. This doesn't mean becoming an expert in every field. It means having working knowledge of key models from various disciplines and recognizing when they apply to financial questions. Understanding how incentives shape behavior, how systems tend toward equilibrium, how evolution favors what survives rather than what's optimal, how network effects create winner-take-all dynamics. All of these concepts from non-financial fields improve investment thinking. The practical application is reading widely beyond finance. Study psychology to understand biases and decision-making. Study mathematics to understand probability and compounding. Study history to understand cycles and human nature. Study biology to understand adaptation and competition. Build a toolkit of mental models that you can apply to financial decisions. This investment in broad learning pays dividends across your lifetime because better models produce better decisions in countless situations. The seventh rule is that opportunity cost is a huge filter in life. Every choice has a cost, not just in what you spend, but in what you give up by not choosing alternatives. Money invested in one opportunity cannot be invested in another. Time spent on one activity cannot be spent on something else. Munger was obsessive about opportunity cost because it forces explicit trade-offs rather than treating each decision in isolation. In investing, opportunity cost means comparing every investment to the next best alternative. If you're considering buying a stock, the relevant question is not just, will this make money, but will this make more money than the best alternative use of this capital? If you're holding cash, the opportunity cost is the returns you could be earning in investments. If you're holding a mediocre investment, the opportunity cost is the returns you could be earning in better investments. Most people ignore opportunity cost, evaluating each choice as binary. Do it or don't. But the relevant comparison is do this or do the next best alternative. This changes many decisions because something can be good in absolute terms but bad relative to alternatives. Buying a decent investment at a high price might produce positive returns. But if you could buy a better investment at a better price, the opportunity cost makes the first choice poor. The practical application is always asking, compared to what? Before making any significant financial decision, explicitly identify the next best alternative and compare. This is tedious but valuable because it forces clear-eyed evaluation of trade-offs rather than emotional decision-making. It also encourages patience because sometimes the best use of capital is waiting for better opportunities rather than deploying immediately into mediocre options. The eighth rule is that the best armor of old age is a well-spent youth. Munger applied this to financial life. The best security in later years comes from prudent decisions in earlier years. The person who saves and invests consistently through their 20s, 30s, and 40s has enormous advantages in their 60s and beyond. The person who consumes everything they earn delays security indefinitely. This principle emphasizes that time is the ultimate non-renewable resource in wealth building. You cannot reclaim lost years of compounding. Starting at 25 versus 35 might mean hundreds of thousands or millions in difference at retirement because of the extra decade of compounding. The decisions you make when young compound into your circumstances when old. The psychological challenge is that when you're young, retirement seems impossibly distant and irrelevant. The temptation to prioritize present enjoyment over future security is intense. But Munger would argue that this is precisely backward. When you're young, you have time, which is the most valuable asset in compounding. Wasting this asset through consumption is tragic because you cannot buy it back later. The practical application is to treat your younger years as the foundation for your later years. Develop good financial habits early. Save and invest consistently. Learn valuable skills. Build human capital. Avoid debt. Make decisions with a 30 or 40-year horizon. Your 65-year-old self will be grateful that your 25-year-old self thought long-term. The ninth rule is that understanding incentives is fundamental to understanding behavior. Munger called this the most powerful force in the world. People respond to incentives often unconsciously, and these incentives frequently create outcomes that contradict stated intentions. If you want to predict behavior or understand why systems work as they do, follow the incentives. In finance, understanding incentives explains countless behaviors that otherwise seem irrational. Why do brokers recommend actively managed funds? Follow the incentives, higher commissions. Why does financial media focus on daily movements? Follow the incentives. Fear and greed drive viewership. Why do many mutual funds closet index while charging active management fees? Follow the incentives. Gathering assets produces fees regardless of performance. Understanding incentives protects you from conflicted advice. When someone recommends a financial product or strategy, ask, what do they gain if I follow this advice? If their incentives are misaligned with yours, treat the advice skeptically. Most conflicts of interest are not about bad people, but about structures that reward behavior that benefits the advisor at the expense of the client. The practical application is never taking financial advice without understanding the advisor's incentives. Who benefits if you follow this recommendation? How is the advisor compensated? What would they suggest if they were in your position with your goals? These questions often reveal that incentives encourage recommendations that aren't in your interest. Once you understand this, you can either find advisors with aligned incentives or make decisions independently. The 10th rule is that simplicity is the ultimate sophistication. Munger favored simple approaches over complex ones because simplicity is robust and understandable, while complexity creates opportunities for errors and hidden risks. Most sophisticated financial products and strategies are complex to justify fees or to obscure their actual risk-return profiles, not because complexity produces better results. In investing, simplicity means strategies that anyone can understand and implement. Buying low-cost index funds is simple and works. Buying quality businesses at reasonable prices is simple and works. These approaches don't require constant monitoring, complex models, or expertise in derivatives. They work because they're based on sound principles, not because they're clever. Complexity often destroys wealth. Complex strategies have more points of failure. They require constant management. They are harder to understand, making it difficult to know when something is going wrong. They often involve leverage or derivatives that can create catastrophic losses. The 2008 financial crisis was largely about complex financial products that even their creators didn't fully understand. The practical application is to favor simple financial strategies and to be deeply skeptical of complexity. If you can't explain an investment clearly to a 12-year-old, you probably don't understand it well enough to own it. If a strategy requires constant monitoring and adjustments, it's probably too complex for most people to execute well. If a product has fees layered on fees and structure you can't pass, avoid it. Simplicity is not just elegant, it's effective. The 11th rule is that it's not supposed to be easy. Anyone who finds it easy is stupid. Investing is difficult because it requires doing things that feel wrong. Buying when others are panicking, selling when others are euphoric, being patient when action feels necessary, thinking long-term when short-term performance dominates attention. This psychological difficulty is why most people fail, despite the principles being simple. Munger rejected the idea that wealth building should be quick or effortless. The people who claim it's easy are either selling something or mistaking luck for skill. Sustainable wealth building requires decades of discipline, which is psychologically demanding. You have to delay gratification. You have to withstand volatility. You have to resist social pressure. You have to maintain conviction when doubting yourself. None of this is easy. Accepting that it's difficult is liberating because it means you can stop looking for easy paths and focus on doing what's effective despite difficulty. The search for easy often leads to schemes that promise quick wealth with no effort. These schemes fail, but people keep searching because they want easy more than they want effective. Understanding that effective wealth building is necessarily difficult helps you maintain realistic expectations and persist through challenges. The practical application is to stop expecting investing to be easy and to prepare for the psychological challenges. Build systems that help you do difficult things. Automate savings so you don't have to choose repeatedly. Write down your strategy so you can follow it when emotions are intense. Limit exposure to information that triggers emotional responses. Recognize that if investing feels easy, you're probably doing something wrong, likely taking risks you don't recognize. The 12th rule is that you don't have to have an opinion on everything. Munger and Buffett were famous for saying, "I don't know," when asked about things outside their expertise. They were comfortable not having opinions about industries, technologies, or investments they didn't understand. Most investors feel they must have opinions on everything, which leads to uninformed decisions. The pressure to have opinions comes from multiple sources. Financial media constantly asks what you think about various market topics. Social conversations involve sharing investment views. Portfolio management is presented as requiring constant decisions. But this is all noise. You don't need opinions on things you don't understand. You only need opinions on the few things within your circle of competence where you can make informed decisions. Saying, "I don't know," or "that's outside my area of understanding" is a position of strength, not weakness. It shows intellectual honesty. It prevents costly mistakes. It allows you to focus energy on areas where you actually have edge. Most people are afraid to admit ignorance, so they fake expertise, which leads to poor decisions in domains where they have no business investing. The practical application is to become comfortable with uncertainty and ignorance outside your circle of competence. When asked about investments or market topics you don't understand, say so directly. Don't fake opinions. Focus your attention on the few areas where you have genuine understanding. Ignore the rest. This focus produces better results than spreading attention across many areas where you lack real insight. The 13th rule is that the big money is not in the buying or selling, but in the waiting. Munger emphasized patience as perhaps the most important investor quality. Most people cannot sit still. They feel they must act, must trade, must do something. This activity typically destroys value through costs, taxes, and bad timing. The investor who can wait, who can hold quality investments through volatility and cycles, typically produces the best returns. The mathematics support this. Transaction costs, taxes on short-term gains, and behavioral errors from frequent trading all reduce returns. Meanwhile, letting quality investments compound for years or decades allows growth to accelerate. The difference between a 10-year holding period and a 1-year holding period isn't just returns, it's compounding, tax deferral, and avoiding countless opportunities to make emotional mistakes. Psychologically, waiting is difficult because it feels passive. It doesn't scratch the itch to do something. It requires watching your portfolio do nothing for long periods while others seem to be actively making money. But this appearance is misleading. The active traders are usually destroying value while the patient holder is allowing compounding to work. Patience looks boring but produces results. The practical application is to deliberately reduce activity. Before making any trade, ask whether it's necessary or whether you're just feeling the urge to do something. Structure your approach to minimize trading. Buy quality, hold indefinitely, unless fundamentals change. Ignore price fluctuations. Track your holding periods and try to extend them. The longer you hold, the more compounding works in your favor and the fewer opportunities you create for costly mistakes. The 14th rule is that the best way to get what you want is to deserve what you want. Munger applied this to wealth and success generally. You don't get wealthy through luck or shortcuts. You get wealthy by providing value, making good decisions, and avoiding mistakes consistently over decades. You earn wealth through skill, discipline, and rationality, not through gaming the system or following get-rich-quick schemes. This principle is both practical and ethical. Practically, trying to get rich without deserving it leads to speculation, fraud, or schemes that fail. Sustainable wealth comes from creating value, whether through business, investments, or career. Ethically, deserving what you get means operating with integrity, treating others fairly, and building reputation and relationships that enable long-term success. Applied to investing, this means doing the work to understand what you're investing in, thinking carefully about decisions, managing risk appropriately, and playing the long game. It means not trying to beat markets through clever timing or hot tips, but through patient accumulation of quality assets at reasonable prices. This approach is less exciting but far more reliable. The practical application is to ask yourself, do I deserve the results I'm hoping for? Have I done the analysis and thinking required? Am I taking appropriate risks? Am I focused on creating or finding genuine value? If the honest answer is no, then your expected results are based on luck, and luck is not a sustainable strategy. Focus instead on deserving success through sound thinking and good decisions. The 15th rule is that the highest reach of civilization is a seamless system of trust. Munger believed that low-trust societies and systems are expensive and inefficient, while high-trust systems enable prosperity. Applied to personal finance, this means operating with integrity, maintaining your reputation, and being careful about who you trust with your money. Your reputation is an asset that compounds or deteriorates based on your behavior. Acting with integrity in financial dealings builds trust that creates opportunities. Being known as reliable, honest, and fair in money matters makes others willing to work with you, invest with you, or help you. Conversely, cutting corners or acting in bad faith destroys trust and closes doors. Being careful about who you trust with your money is equally important. Most financial fraud happens not through sophisticated schemes, but through trusting the wrong people. Bernie Madoff's Ponzi scheme succeeded because people trusted him based on reputation rather than verifying claims. Countless investment frauds rely on trust rather than scrutiny. The practical application is twofold. First, maintain your own integrity in financial matters. Keep your word, act honorably, treat others fairly, build a reputation worth protecting. Second, verify before trusting others with your money. Trust, but verify. Ask for documentation. Understand how your money is being used. Be skeptical of claims that seem too good to be true. High trust in systems requires verification, not blind faith. If you've engaged with these 15 rules, you understand that Munger's wisdom was not about clever tactics or market predictions. It was about clear thinking, rational decision-making, and disciplines that prevent mistakes more than they enable brilliance. These rules work because they're based on mathematics, psychology, and human nature, not on market timing or stock picking. This channel exists to explore these timeless principles of rational investing and clear thinking. If this approach resonates with you, I'd appreciate if you like this video and subscribed for more content focused on wisdom and discipline rather than hype and speculation. Let me close with a synthesis of these 15 rules and how they fit together. Munger's approach was about building a lattice work where multiple principles reinforce each other. Inversion reveals risks. Circle of competence focuses effort. Avoiding stupidity prevents disasters. Rejecting envy maintains focus. Teaching reinforces learning. Worldly wisdom enables better decisions. Opportunity cost forces trade-offs. Long-term thinking aligns today's choices with tomorrow's security. Understanding incentives prevents manipulation. Simplicity reduces errors. Accepting difficulty maintains realistic expectations. Being comfortable with uncertainty prevents overreach. Patience allows compounding. Deserving results ensures sustainability. Trust builds systems that work. None of these principles is revolutionary. They're mostly obvious when articulated, but obvious and practiced are entirely different. Most people know these principles intellectually, but violate them constantly through their behavior. They understand compound interest, but don't save. They know envy is destructive, but can't resist comparison. They recognize that patience matters, but trade compulsively. The gap between knowledge and behavior explains most financial failure. Munger's advantage was not that he knew principles others didn't. His advantage was that he actually lived by principles that others merely acknowledged. He inverted problems rather than just thinking positively. He stayed within his competence rather than speculating beyond it. He avoided stupid decisions rather than seeking brilliant ones. He ignored envy and focused on absolute progress. He was patient rather than active. He did the difficult things consistently rather than seeking easy paths. This is what made him successful and what made his wisdom valuable. He proved that these principles work not just in theory, but in practice over 7 decades of investing. He built enormous wealth, not through brilliance or luck, but through rational thinking and disciplined behavior. He made mistakes, acknowledged them, learned from them, and gradually eliminated categories of error until his decision-making was qualitatively superior to that of most investors. You can apply these same principles. They require no special intelligence or privileged information. They require only the discipline to think clearly and act rationally despite psychological and social pressures that work against you. This is achievable, It's not easy, as Munger would remind you, but it's achievable. The world will continue to promote complexity over simplicity, activity over patience, short-term excitement over long-term thinking. Financial media will continue to create noise that obscures signal. Social pressure will continue to encourage envy and comparison. The psychological challenges that make investing difficult will not disappear. What can change is your response. You can implement these 15 rules systematically. You can build checklists that prevent common errors. You can design systems that make rational behavior default rather than exceptional. You can develop habits that compound in your favor over decades. The question is not whether these rules are correct. Their validity is proven through logic and through Munger's results over his lifetime. The question is whether you'll actually implement them consistently, despite difficulty, despite boredom, despite temptation to abandon discipline for excitement or to seek easy paths rather than effective ones. Most people won't. Most people will continue making the same mistakes that Munger's rules would prevent. They'll chase returns, trade compulsively, invest outside their competence, let envy drive decisions, seek complexity, expect easy wealth, and wonder why they're not succeeding. The principles are available to everyone, but few will actually practice them consistently. You can be different. You can treat these rules as foundational rather than as interesting ideas. You can build your financial life around them. You can let them guide major decisions. You can return to them when tempted to deviate. Over decades, this consistency compounds into dramatically better outcomes than you would achieve through cleverness without discipline. This is Munger's legacy. Not a formula for quick wealth, but a framework for rational thinking about money that produces sustainable results over lifetimes. Not secrets, but clarifications of what works and why. Not complexity, but simplicity, properly understood and consistently applied. The 15 rules we've discussed are not comprehensive. Munger shared many other insights over his lifetime, but these capture core principles that, if followed, would prevent most wealth destruction and enable most wealth building. For most people, they're sufficient. The question is whether they'll be implemented. Thank you for watching. Now go review these rules, identify which ones you're violating, and build the systems that will help you live by them consistently, despite difficulty. That's the path Munger walked, and it's the path available to anyone willing to think clearly and act rationally over very long periods.